Hi, I'm Rob.
And I'm Rob.
And this is Ask Rob and Rob.
Hello, this is Ask Rob and Rob, and I sounded a bit surprised that I was Rob then, but don't worry, I'm back with it mentally, and I'm here to answer your questions. But before we get into it, let's give you a quick reminder of how you can get your question into the show.
Yeah, so simple. Just go to propertyhub.net/ask. You can send us a written question for our Sunday Times column there, or you can send us a voice note with a question that we can answer on this here show. And that is what Simon has done.
Hi Rob and Rob, my name is Simon. I'm in my early 60s and belatedly starting to plan my transition to retirement. I'm single and have a reasonable income, but want to start thinking about slowing down. I rent a cottage that I love and would prefer not to move, for the foreseeable future anyway. This means I need to have some kind of inflation-proof income and would also prefer to split the risk rather than having all my savings in a pension fund. I have a decent pension pot, so with some savings and the tax-free lump sum I can extract, I have around 150k to start building a property portfolio. I'm a higher rate taxpayer, so I assume the best thing to do would be to set up a limited company, and I do not plan to take any cash out of the business for at least 5 years. My target is to build a portfolio that gets as close to generating 24k per annum revenue by 2030. Realistically, while I'm working my current role, I'm time poor. Over the next 5 years, as I transition into either a shorter working week or a less demanding job, I may be able to spend more time getting involved with my property business. I'm a complete property novice, so I'm currently trying to educate myself. I am watching and listening to everything I can find. I'm especially enjoying watching and listening to your excellent back catalogue of videos and podcasts. Thanks very much for those. My next step is to formulate a practical strategy and start putting it into action. I've had various initial calls with a few companies and have a few more lined up, including with some specialist mortgage brokers. As you can imagine, I've seen and heard some conflicting views and opinions. In particular, I'm struggling with the following aspects of my strategy. I do not have a mortgage or property now, so even assuming I can get a buy-to-let mortgage straight away, would I be overpaying too much? Would I be better off instead buying my first property for cash, then raise a mortgage on this after 6 months or a year? Or should I split my capital and go for 2 or 3 properties with mortgages straight away? I know that normally you would advise people to focus on capital growth rather than cash flow and yield, but does my situation and objective change this? Should I buy properties that need to be refurbished, or am I better off buying newly built or refurbed from developers? And finally, I've heard that better yields can be achieved with short-term company lets. So would that be a better bet for me initially, at least for part of my portfolio, or would you advise me to stick with regular buy-to-lets? Thanks again for everything that you do.
Simon, thank you for your question. And you're at a really exciting point, and you're in a great position because you've got the capital, you're building your knowledge, and it's just a case of figuring out the best way forward. The good news is you're doing all the right things already. I know that because you're asking the right kind of questions, and you've also said that you are speaking to mortgage brokers and other professionals, which is precisely what you should be doing. Oh, and listening to the show, of course. So let me see if I can hit on the specifics from your question. Firstly, should you be investing in a limited company? The answer to that is, of course, ask a tax professional. You absolutely should take advice because it's a big decision. I would say, based on what you said, probably the answer to that will end up being yes, because it would be prohibitive to take money out of that company while you're still earning. But you could start drawing from it when your other source of income has stopped, which would work a lot better. But like I say, definitely take tax advice to confirm that. Your next question was, should you be buying with cash? Should you be using a mortgage? Should you be buying 2 or 3 properties straight away? Ultimately, to get to your goal, you will need to use mortgages. It's the only way the numbers will work. But that doesn't mean that you have to do that straight away. And that ties into your next questions, like should I buy properties that need to be refurbished? Should I buy new builds? Should I do short-term lets? For me, I would say just do the first one and keep it simple. So bear in mind that I don't know anything about you or your situation beyond what you said. But as a general point, when you do your first property deal, your first transaction, there's a lot to learn. It can be a bit intimidating and there's potential for you to make mistakes. So it's always good to make the first one as straightforward as possible. So then for the next one, you go, great, I know all the basics now. If I want to add something a bit more spicy on top, I can do. So I would be inclined to keep it simple, do a normal let, nothing fancy, stay away from anything that needs anything more than a minor refurb. And you could buy it with cash if you wanted to, because 6 months later, you could then take out a mortgage and you wouldn't be any further behind. You can speak to a mortgage broker to see if there's any advantage to doing that or not. Then once you've got that property under your belt, you'll know a lot more. You'll know if property's for you or not. Did you enjoy the process? Did you not? And then, as you've said, you'll have more time becoming available. Then you can start looking into other options. With regard to capital growth versus income, in your case, as you're looking for an income from property in the relatively short term, I would definitely expect you to be less biased towards capital growth than, say, I would be, given that I don't want to be drawing any income in the foreseeable future. But as we often do on this show, I would caution you away from going for the absolute highest yield possible, because that guides you towards properties in less desirable areas that tend to come with their fair share of problems. And you may not be able to collect in practice all that money that you're supposedly going to be getting on your spreadsheet. So I would say, Simon, keep doing your research, keep talking to mortgage brokers, take some tax advice, start out by keeping it simple and take it from there.
Simon, I think you got lucky there. That was multiple questions in, and you got multiple answers back. Rob has been very generous there. Well done, Rob. Let's see if I've got a nice, easy question to answer.
Hi, Rob and Rob. It's Geoff. So my question is where tactics and politics meet. I want to know how you would approach deploying £100,000 over 25 years from December if we have a Labour government in power. And before you polish your crystal ball, let me elaborate a bit. Thanks to you guys and my elbow grease, I've managed to have enough knowledge to buy my first property in 2022 for 16% below asking price. I'm now in the process of selling after having lodgers live with me to pay the mortgage and should walk away with £100,000. Strategically, the plan is to scale up to 16 £1,000 per month generating flats, and then after the 25 years cash out and clear the debt on 8 of them and leave that as the income generating part of my retirement. So I'm wondering how you would approach buying in a potential Labour government market in December. And yeah, I'm either targeting Milton Keynes, Birmingham or Leeds for the first 2 flats. Yeah, all help would be welcome. And don't say just buy it anyway, because in 25 years you won't care. Give me something tactical to work with. Thanks a lot. All the best. Bye.
Geoff, you've given me politics. I'm sure we won't lose any listeners on this one. Right. How will the Labour government impact your investment strategy and tactically what you can do? Geoff, I think you're overthinking it. I'll get straight to the punchline. I don't think it makes much of a difference. This is a very different Labour government than some of the other Labour governments that have tried to gain power in the last few years. And actually, some would argue, and you don't have to agree, but some would argue that the Tories have moved into Labour's territory anyway when it comes to housing and property, and have just adopted all the things that Labour said they would do in the first place. There seems to be, at least from a property point of view, very little between the two. Now, of course, there will be some changes that will make a difference, but I don't think it's anything meaningful. And I don't think you should care. I used to care about these things when I was younger, but I don't anymore, because what I've realised is, unless it's an extreme government, and I don't believe any of the options that we have available to us are extreme, then it's normally business as usual. We've had far more extreme things happen to us in the last couple of decades as property investors. Brexit, for example. Now, that was a real curveball, and people panicked off the back of it, but things just carried on. COVID, that was kind of a big deal, right? Pretty awful. But yet, property investment, again, was resilient. If you approach it over the long term, and you've suggested 25 years, then you'll be fine. In that 25 years, Geoff, you'll see different governments. And hopefully, most of them do a half-decent job. But the point is, you control your destiny. It won't be down to what government is in place to whether you'll be successful or not. Some people would like to use that as an excuse, but I don't think you and others listening would take that approach. It is not those external factors that will determine if you're a success or not. So ignore the noise of the election, invest for the long term, and you will do fine.
Well, Geoff, you asked for something tactical. So I'll offer you something potentially tactical to add to what Rob said, which I completely agree with, which is that you could say, well, Labour government comes in, they immediately start making some scary noises about their housing policies. Landlords rush to sell up, which gives you a really nice soft market to be buying into. So your tactical point could be wait till around the time of the election before buying. And the best time would probably be just before the election, because that's when you're going to have all the hype and the hyperbole. It's when people are going to be the most fearful. After the election, things settle down, people like to have certainty, and things will probably carry on much as before. So that could be your buying window. So that's a potential tactical piece. Would I be doing that? No, because that might play out, but also it might not. And we had a recent YouTube video, and we've been talking about it on the podcast recently as well, about how conditions for buying are pretty good right now. And it's possible that those conditions will get worse. So that's something that you could be doing, Geoff. But ultimately, I would be doing what Rob's just said and just carrying on. Be looking for good deals all the time. You got a good deal last time. Keep on looking. And when you find one, pounce on it, regardless of what's going on in the world of politics. So that is us done for this episode of Ask Rob. Thank you so much to our question askers, and thank you to you for listening. We'll see you next time. Bye-bye.
Bye-bye.